Hi, Mike Flores here, co-founder of Trade Prosper, and welcome to this next video in the Killer Crossover section. In this video, we're going to talk about short-term moving averages. In the previous video, I showed you the 50 crossing the 200, or the Golden Cross or Death Cross. Now in this video, I'm going to show you the 10-day moving average crossing the 20-day moving average. And what I've done, what you see on the screen are a bunch of illustrations which I created in order to make it easier for us to understand what's going on. Okay, so let's begin. Let's start all the way from the left and let's talk about what this technique is. Okay, so similar to the technique shown in the last video, the Golden Cross and the Death Cross, you buy when the short-term moving average crosses over the long-term moving average. So on this chart, you see the black dotted line and a purple dotted line. So as we scroll over, starting all the way from here to the left, you'll see that the black dotted line to the right of the cursor, it says moving average 20. And just above that, it says moving average 10 in purple. So the black dotted line is the 20-day moving average, and the purple dotted line is the 10-day moving average. So I added those the same way I did before by clicking on the wrench, choosing Add Indicator, clicking on Moving Average, and then another box pops up and I change the number of periods and the color. Now I'm going to delete this one because I'm not going to use it. We already have the 10 and the 20 there. You see the 10 is purple and the 20 is black. Alright, so now that we have them on there, let's talk about why I like the 10 and 20-day moving averages. There's two main reasons why. I like them because they help capture small chunks of the market move, which I'll show you in a moment. But more importantly, it allows you to get into the larger moves earlier. So what I mean by that is with the 50 and 200-day moving average crossover, the move has to be well underway before you get an actual crossover signal. In this crossover method, you get the signal to capture the large part of the move very early on. But before I show you that, let's start from the left again and talk about what we have here in the boxes. So this first box says sell market on close. The high price of the entry day is the initial stop loss. So this is one example that I gave you as the stop loss, the high of the entry day as the initial stop loss. Now, on the entry day, here, you can see that the moving average 20 is at 0.89644 if you look to the left of the cursor. You can see the moving average 10 is at 0.89614. So at this day, you would sell market on close, which means right before the market closes, you would just sell, and your stop would be the high of the day in this example. Now, it might look like they crossed over the previous day, but as we scroll over that, you can see that the moving average 10 to the left was 0.8968 and the moving average 20 was 0.8967. So the crossover actually didn't happen on that day, it happened on this day. Okay? So now let's talk about the stop losses. I told you the stop loss in this case was the high of this day. So we sold market on close, and the stop would have been the high of the day, which if you look to the left of the cursor, you can see is 0.8946. So now that I've shown you that, you can see that in this instance, you would have gotten short on this day. You'd have been stopped out of on the very next day if you use your stop as the high, and then you'd have to wait all the way till over here, another couple weeks, before you got back into this market using this method. Now that's one stop. The other stop is you could use the actual crossover day. So meaning the actual crossover on that day. So this day that it crossed over, you stay in the market until it crosses back over. So on this day I would have gotten short, and I'd stay in this market, stay short, until this day. I exit the short, and now I get long because we've crossed to the upside. So that method keeps you in the market all of the time. Okay, so there goes the difference. The first stop method I showed you, which is outlined here in the boxes, you would have gotten stopped out on the second day and would have had to wait till over here to get back in. This second method that I'm talking about, you only get in and out of the market on the day the moving averages cross over. So crossed over on this day, you get short. Cross back over on this day, you stop out of the short, and now you get long. That's called always in. Okay, so what I did was I put together a slide with the possible stop loss options. So we just went over using the high or low of the bar on the crossover. That's what I labeled on the charts. So you see here the high or low of the bar on the day of the crossover. Now your stop could be close, and so you could be susceptible to being stopped out quickly, which happened in our example. You were stopped out the next day. Now this choice makes the technique possibly not always in the market, right? We showed you got in short one day, the next day you were stopped out, and you had to wait a couple weeks to get back in. The second one I showed you was the point of crossover. Now that stop could be far away from the actual entry level. So this stop makes the technique always in the market, meaning the day the crossover happens, you wait for the crossover to the opposite side to get stopped out and then enter the other way. So in our example, we got short on the crossover, and then on the second one, we got long, and let me show you that on the chart briefly. So to refresh, using that method, the second one, you would have gotten short on this day that the crossover happened, and then you would have been in the market until this day, then you would have stopped out and then gotten long. That's the always in technique. And then this third method is using key previous resistance or support levels. Now this stop choice also makes the technique possibly not always in the market. So let's just look at that on the chart briefly. So as we've spoken about before, this is the day you would have gotten short on the crossover. So instead of using the high of this bar as the stop or using the crossover as the stop, we use previous resistance. So you could say these highs up here, if it breaks back above here, then I'll stop myself out. If it breaks back above here, I'll stop myself out. That's just another choice, another option for you to use. So now I've given you 3 possible stop losses that you can use, and you can use whichever one you're comfortable using. I tend to use the stop as the bar, the high or low of the bar of the breakout day. So in this case, I'm showing you the stop that I normally use when I use this crossover method. Now, I like choosing that as my stop because in short-term moving averages, we get more crossovers than we do in longer-term moving averages. So you can see here we have a crossover here, a crossover there, potential crossover here, and sometimes you get more multiple crossovers depending on the way the market's going. So I like to be a little conservative and keep my stops a little tighter in this method. Another way you can do this is you can use options to trade this method. And my colleague Billy will be showing you that in another section. Okay, so let's move on now. So we got short this day on the initial cross. We were stopped out the next day using our stop as this high. And now we wait to get back in the market. Now on this day, the market crosses back over and we get long. And my stop is the low of this day. The low of this day is now my stop. Now look what happens. The market just continues to go. And I've caught this big trend very far on. Now here, I'm going to show you this because this looks like it gets really, really close. But I don't want you to exit on this day because the market does not actually cross over. Now let me zoom in to show you that. So you can see here it gets really close. But if you look to the left, you see the moving average is still 9.9075 for the 10-day and 0.9070 for the 20-day. So it doesn't actually cross over on any of these days. So you still stay long in this market. See that? This one gets closer. 9078, 9075. You still stay long. Close, but no cigar. So now basically you stay in this market until the market crosses back below. Once you have the crossover, now you get out of that market. So once it crosses down to the bottom side, you exit the market and now you get short. So we're waiting. That hasn't happened just as of yet. And then as we go along, you see here on this day, it happens. The crossover happens and now you exit the market on close on this day at 94.62. So you got in originally back on July 15th at 89.56, and then you exited on October 17th at 94.62. That's a huge, huge trade. So looking at that there, that's why I love this technique, because you can catch a really big move early on. Like I said, the 50 and the 200-day moving average cross would have happened way later on, somewhere around here. Now I like this chart. I showed it to you because I had a real short entry and a long entry right here all in one market. This is a very good move, and I caught this move. And now I hope you see the power of the short-term moving average crossover. And when Billy shows you how to use options, it'll be another way to use this method to your advantage. Now there's many derivations of the short-term moving average crossover, many different time periods, but I'm showing you the 10 crossing the 20 because that's what most Wall Street traders use. Now, we didn't get this technique and pull it out of thin air. There is a famous trader named Richard Donchian, and he ran the first managed futures fund in history. He's credited with coming up with many brilliant trading systems. And what was really interesting about Richard was that he traded into his 90s, and he didn't become a truly successful trader until he reached his mid-60s. So that's pretty awesome if you ask me. Richard was very famous for successfully creating the 5-day crossover of the 20-day moving average back in the 1940s. And like I said, since then there have been many derivations, but the one that's most commonly used is the 10 crossing the 20. I've seen studies that show that this crossover is the most profitable one short-term overall. But in all actuality, some markets respond slightly better to other time periods, but the 10-20 has been proven to be the best on average for all short-term signals. There's another famous trader who loves the moving averages, and his name is Marty Schwartz. He's a legendary trader, and he's featured in the classic book Market Wizards. If you haven't read Market Wizards, I highly recommend everyone reads it immediately. If you're going to be in this business and you're going to be investing in the financial markets, you have to read Market Wizards. Now, Marty's a huge fan of moving averages, and he claimed they were his best trading tool and warned to never go against them. And Marty's favorite moving average was the 10-day moving average. Alright, that's the end of this video. I'll talk to you guys in the next one. See you soon.